Hey everyone, welcome back. We all want to cut through the noise and get right to what matters, right? So today we're going to really zero in on gold investing, specifically how to avoid some of the biggest and most common mistakes people make.
Right. It's such a fascinating area, but also one where, honestly, it's easy to trip up if you're not careful.
And to help us navigate these potential pitfalls, we're turning to Doug Young and his bulletin, Gold Investing Mistakes to Avoid. I mean, this guy's got over 20 years of experience across the board, from commodity trading to, of course, precious metals.
Yeah, Doug's been there, done that. And what I appreciate is his focus on really empowering people to make smart decisions. So, with this deep dive, our goal is to extract that real actionable advice from his bulletin, the stuff that'll really help you navigate this whole gold investment landscape effectively.
Absolutely, and avoid some of those costly mistakes that, let's be honest, a lot of people fall into. So let's jump right into it. Mistake number one, and this is a biggie, investing in gold with a short-term horizon. Doug really emphasizes the importance of taking that long view.
And there's a good reason for that. I mean, historically, the value of gold has generally trended upwards over time. But in the short term, yeah, its price can jump around quite a bit.
So there's that natural volatility. But beyond just the price swings, what's the real danger of going in with that short-term mindset?
Well, think about the mechanics of actually buying and selling gold. There's this thing called the spread, which is basically the difference between the price the dealer is paying for gold and what they're selling it for.
So you're already starting a little bit in hole right off the bat.
Precisely. So if you're trying to, let's say, make a quick profit and the gold price isn't moving much, that's what we call a period of consolidation, you could easily end up having to sell for less than you initially paid, even before factoring in any fees or commissions.
Yeah, it's not as simple as just buying low and selling high, especially if you're in a rush.
Exactly. And let's face it, trying to day trade gold, that's a quick way to potentially get burned. And you definitely wouldn't want to put money into gold that you might need next month for, say, a sudden car repair or something, because you might be forced to sell at a loss.
Makes perfect sense. So gold might be a good hedge against inflation or economic uncertainty in the long run.
Right. Those are typically longer term strategies, right?
But it's definitely not a get-rich-quick scheme.
No, not at all. It's more about preserving wealth and building a solid foundation.
Okay, mistake number two, relying too heavily on gold ETFs, specifically GLD, instead of holding actual physical gold. Doug makes a pretty strong case for having that tangible asset in hand.
Yeah, and this is where things get interesting. It's about understanding the fundamental difference between holding something physical, those actual gold bars or coins you can see and touch, and having shares in a financial product, like an ETF.
Right, so an ETF like GLD is meant to track the price of gold, but it's not quite the same as owning the metal itself.
That's exactly it. You're essentially buying shares in a fund that holds gold, but you don't actually possess the gold directly. And this is where Jug brings up the concept of counterparty risk. And he specifically highlights this with GLD because of the way its prospectus is written.
Okay, counterparty risk. Can we break that down a bit? I'm sure some folks are thinking, what does that even mean?
Sure, it's a fancy term, but in this context, it basically boils down to the risk that the other party involved, in this case, the trust that holds the gold on behalf of investors, might not be able to meet their obligations. Like in a really extreme scenario, right?
So let's say in some very unusual market conditions, something happens and the fund can't actually deliver the gold that backs your shares.
Yeah, and that's where things get tricky. Doug points out that GLD's prospectus has clauses that, if things were to really go south, could actually favor the trust, leaving investors in a potentially precarious position.
So it's kind of like you're trusting that everything will run smoothly and that the fund will always be able to back up your investment with actual gold.
And most of the time, it probably will. But Doug's point is that if true security is your aim, if you really want to know that your investment is safe, physically holding that gold might be a more direct route.
Makes sense. Okay, let's move on to mistake number three, investing in gold jewelry. I know a lot of people who think their gold chains and bracelets are a solid investment.
Yeah, it's a common misconception, but Doug is pretty clear on this one. Gold jewelry is not the way to go if your goal is purely financial return.
Right, it's more than just the price of gold that determines the value of a piece of jewelry.
Exactly. You've got the design, the craftsmanship, the brand name, all these other factors that play a role. And then there's the sentimental value that people often attach to their jewelry, which has no bearing on its actual market value.
So that beautiful gold ring you bought, might be worth a lot less than its weight in pure gold if you tried to sell it just for the metal content.
You're paying a premium for the artistry, the design, the whole experience, and that's fine if it's something you cherish. But as an investment, not so much.
Right, you're not getting the same kind of direct exposure to the price of gold as you would with, say, bullion coins.
And that's why Doug recommends sticking with those standardized gold coins if your aim is investment return. Their value is much more transparently tied to the current spot price of gold.
Good to know. All right, let's tackle mistake number 4, which ventures into the realm of numismatic coins. Those rare and collectible gold pieces. And Doug seems to advise a pretty cautious approach here.
Yeah, and for good reason. Numismatic coins can appreciate significantly in value, but it's a very specialized area.
You really got to know what you're doing.
Exactly. And the biggest risk is encountering counterfeit or forged coins.
Oh, wow. Yeah, I hadn't even considered that.
It's a real problem, and there are definitely people out there who'll prey on those who aren't familiar with the nuances of numismatics. They'll try to pass off fakes as the real deal, and if you don't know what to look for, you could easily get scammed.
So unless you're a seasoned coin collector with a deep understanding of grading, rarity, and authentication, you're probably better off steering clear.
That's Doug's advice. For the average investor, sticking to standard bullion coins like American Eagles or Canadian Maple Leafs is a much safer bet.
Right, those are widely recognized, easier to verify, and their value tracks the prevailing gold price much more closely.
Makes sense, right? Now, this brings us to a crucial question for you, our listener. How much do you really know about the specific type of gold you're thinking about buying? Have you done your homework?
It's easy to get swept up in the excitement, but knowledge is power, especially when it comes to investing. Okay, mistake number 5. Falling for those too good to be true offers. We've all seen them. Those are ads promising unbelievable deals on gold. What's Doug's take on these?
He's pretty straightforward. Be very wary of any unsolicited offers, especially those cold calls or emails pushing gold investments.
Ugh, yeah, those are always a red flag.
While there are definitely legitimate opportunities out there, Doug emphasizes that many of these deals are simply not what they seem. And he particularly cautions against falling for these traps in the numismatic coin market, where the potential for inflated prices and counterfeits is even higher.
It's like that old saying, if it sounds too good to be true, it probably is.
Exactly. And when it comes to something as valuable as gold, it's always better to err on the side of caution. Buy from established and reputable dealers. That's the key.
Protect yourself. Don't let the allure of a great deal cloud your judgment.
And that leads us to Doug's 6th and final mistake to avoid: neglecting due diligence, which can lead to falling victim to scams.
And with more and more people turning to gold, especially in times of uncertainty, it seems like those scams are only becoming more prevalent.
Absolutely. And Doug points out that these scammers can be very convincing. They know what to say, how to appeal to people's fears and desires. That's why doing your research, that due diligence, is so important. You need to really vet the companies you're considering doing business with, understand the products being offered, and be wary of high-pressure sales tactics.
Don't be afraid to ask questions, dig deeper, and seek independent verification. You're investing your hard-earned money. You deserve to be confident in your choices.
That's a great point. It's not enough to just decide you want to invest in gold. You need to invest the time and effort to ensure you're dealing with legitimate players.
So, just to recap, Doug Young's wisdom boils down to these 6 key takeaways. Prioritize a long-term perspective when it comes to gold investing. Understand the differences between physical gold and those ETFs like GLD. Don't fall into the trap of thinking gold jewelry is a primary investment. Approach rare coins with extreme caution unless you're an expert. Be suspicious of those too good to be true deals. And always, always do your research to protect yourself from scams.
Yeah, he lays it all out pretty clearly. And honestly, his advice is incredibly valuable for anyone considering gold, whether you're a seasoned investor or just starting out.
Absolutely. And as you, our listener, think about your own financial goals, consider which of these pitfalls might be most relevant to your individual circumstances. What are your objectives? What's your risk tolerance? These are the questions to ask yourself.
And here's one final thought for you to chew on. Given that long-term focus that Doug emphasizes, what might be one specific strategy for incorporating physical gold into a diversified portfolio while mitigating those risks we've discussed?
Really interesting question. Food for thought, for sure. We hope this deep dive has given you a solid foundation for making more informed decisions about gold investing. Keep exploring, keep learning, and as always, thanks for joining us.